Global bond market warning, structural risks and monetary reset. 1. The rise of global yields. Across the United States, Japan, and Europe, long-term government bond yields are rising simultaneously. This phenomenon is not a minor financial adjustment but a systemic warning signal. Bond yields, which represent the cost of government borrowing, function as the backbone of global finance. When yields rise, they impact mortgages, consumer credit, corporate borrowing, and equity valuations. Rising yields also increase sovereign debt servicing costs, placing further stress on already fragile fiscal systems. The synchronized rise indicates a structural repricing of risk across nations, not isolated market volatility. Footnote: rising yields foreshadow increased costs for households, corporations, and governments alike. 2. Japan's retreat and its global implications. The Bank of Japan, long the anchor of artificially low yields through bond buybacks and yield curve control, is retreating from this role. 30-year Japanese government bond yields now stand at levels unseen since the 1990s. Japan is the largest creditor nation and, critically, the single largest foreign holder of U.S. Treasury debt. As Japanese yields rise, the return advantage of U.S. Treasuries narrows, particularly when hedged back into yen. Japanese investors, who once provided stable demand for U.S. debt, are beginning to redirect funds back home. Reduced Japanese demand for treasuries, at a time of surging U.S. issuance, forces the United States to offer even higher yields, thereby accelerating debt servicing pressures and heightening systemic vulnerability. Footnote: Japan's domestic shift destabilizes the demand base for U.S. debt at a critical juncture. 3. The exorbitant privilege in decline. For decades, the U.S. has relied on the dollar's reserve currency status, its so-called exorbitant privilege, to ensure global demand for Treasury securities. However, after sanctions and asset seizures against Russia, many nations reassess their reliance on dollar reserves. This de-dollarization trend coincides with trillions in U.S. debt maturing within the next year. Should Japan or other foreign creditors reduce their Treasury holdings, the United States could face a genuine funding crisis. The immediate consequences would include higher interest rates across mortgages, car loans, and business credit, compounded by slower economic growth and potential labor market contraction. In extremis, the Federal Reserve may act as buyer of last resort, monetizing debt and risking runaway inflation. Footnote: the U.S. reserve currency advantage is eroding under geopolitical and fiscal strain. 4. The yen carry trade unwind. Global investors for decades borrowed in cheap Japanese yen and leveraged those funds into U.S. Treasuries, corporate bonds, and equities. This strategy relied on the yen staying weak and the rate gap remaining wide. But when the Bank of Japan began tightening last year, the yen strengthened. Suddenly, trillions in leveraged positions became unprofitable. Investors fled en masse, dumping treasuries and equities. U.S. yields spiked, and stock markets sold off rapidly. Though the episode did not produce a full market crash, it revealed the structural fragility and interconnectedness of Japan and U.S. financial systems. What occurred was only a preview of larger disruptions to come if yield gaps continue to narrow. Footnote: the yen carry trade illustrates how shifts in Japanese policy can destabilize global markets. 5. The puzzle of rising yields amid cuts. Historically, when central banks lower rates or signal cuts, long-term bond demand rises and yields fall. Today, the opposite is happening. Yields are climbing across France, Japan, Canada, the United Kingdom, and beyond. This anomaly points to deeper forces: soaring deficits, record global debt levels, stubborn inflation, and a collapse in central bank credibility. Investors no longer accept the illusion that government promises are risk-free. Instead, they demand higher compensation, signaling an impending structural reset of the financial order. Footnote: rising yields despite easing signals reveal a fundamental breakdown in trust. 6. The Federal Reserve's dilemma. The Federal Reserve faces a contradictory mandate: revive a weakening labor market or contain inflation that refuses to subside. Jobless claims recently surged by 27,000, the highest in 4 years, even as inflation accelerated. Cutting rates could support employment but risk fueling inflation. Raising or holding rates to fight inflation risks worsening unemployment. This policy trap mirrors the conditions that led to stagflation in the 1970s. Official data likely underrepresents the severity of both inflation and unemployment, worsening the policy bind. Footnote: the Fed is cornered between rising inflation and rising unemployment, classic stagflation dynamics. 7. The return of stagflation. The combination of high inflation, high unemployment, and stagnant growth produces stagflation, a phenomenon economists once thought impossible until the 1970s proved otherwise. Following Nixon's severing of the dollar from gold, U.S. debt soared without generating real growth. Wages stagnated, mortgages soared into double digits, and inflation eroded purchasing power. U.S. bonds were derisively labeled certificates of confiscation. Today, with debt even greater, inflation persistent, and growth slowing, a new stagflationary cycle threatens. Rising yields are the market's blunt verdict on unsustainable policies. Footnote: stagflation erodes both real wages and savings, undermining social stability. Perfect. Here's the completion of the report in the same structured Harvard/Yale Law School format. 8. Structural reset of the monetary system. The persistence of rising yields, despite central banks signaling stability or cuts, demonstrates that the illusion has broken. Investors no longer believe debt can be expanded indefinitely without consequence. The global bond market, once the foundation of perceived safety, now signals a reset. This structural reset is not cyclical, it is systemic. The convergence of debt saturation, loss of confidence, and political misuse of currency, including sanctions and asset seizures, ensures that the existing monetary order cannot endure in its present form. Footnote: the global bond market now signals systemic, not cyclical, change. 9. Gold as the historic refuge. During the stagflation of the 1970s, gold soared from $35 an ounce to $850, an increase of over 2,300%. While wages stagnated and bonds lost value, gold preserved and multiplied purchasing power. The same conditions re-emerge today: debt saturation, monetary debasement, and fiscal recklessness. This explains why global central banks are quietly accumulating gold in record volumes. Those who hold their wealth in gold stand to protect, and potentially expand, their position during currency devaluations. History shows that gold does not merely survive crises, it thrives because it lies outside the political manipulation of fiat. Footnote: gold historically preserves purchasing power during systemic devaluations. 10. Legacy, preparation, and protection. The lesson from history is clear: systemic resets punish passive holders of fiat and reward those who anticipate change. As the dollar's reserve status erodes, debt service accelerates, and central banks lose credibility, individuals must prepare. The strategy requires more than speculation, it requires structuring assets to survive inflation, preserve wealth, and secure intergenerational legacies. Physical gold and silver, private trusts, and careful diversification form the pillars of such preparation. Governments may attempt extraordinary measures, but individuals who act early can withstand and even benefit from the transition. The law of precedent is clear: currencies fail, but legacies endure when wealth is preserved in unpoliticized stores of value. Footnote: preparing with tangible assets ensures survival across currency resets.